Section B, high probability TCT model variables. So in section A, we have elaborated on the key fundamentals which you need to understand in depth in order to be able to identify high probability TCT models, which consist of four different variables, which we're going to be diving into in this video. Our high probability TCT model variables consist of four key components, which is going to be one, your quality return to zone. As you guys know, we need to be in a high probability ranging environment, which has to do with getting that quality return to zone. The second is going to be range duration. Our ranges need to have a minimum duration in order for you to avoid taking irrelevant TCT models. The third variable is going to be the quality of the third tab POI. What is the location? What are the exceptions? And how can we minimize the room of error to build extra conviction behind our model? And four is going to be the quality breaker structure and the characteristics of a quality break inside of our TCT model to eliminate any doubts and only trade the highest probability of highest probability models within the game of Wyckoff. And this should also be your checklist going forward when identifying high probability TCT models in a live trading environment. If you have the quality return to zone, if you have the range duration, if you have the quality third tab POI, and you got the quality breaker structure, and you're within the context which makes sense to take the distribution or the accumulation, you need to execute. But we're going to be diving into execution in the later videos. For now, we're going to be elaborating on the four different variables. So, starting off with the quality return to zone. Obviously, we have already elaborated on being able to identify high probability ranges using that return to zone. But when focusing specifically on an actual TCT schematic, there are a few key details I want to dive a bit deeper into regarding using that return to zone to our advantage. So on the left right here, we can just see basically a picture perfect return to zone. We have a model 2 accumulation schematic, and we can draw that return to zone straight from our range high into the market structure high that we're using to confirm our TCT model 2 accumulation, and the breakoff structure confirming the model is simultaneously breaking outside of that return to zone, where the return to zone is visible on that specific time frame just perfectly. Okay, it's just a perfect return to zone that you can visibly see, very obvious on the same time frame, and you have your model 2 accumulation, and the break is perfectly outside of that return to zone. Now, this does not always happen where you get that quality return to zone and all the primary and internal highs are aligning. You also have return to zones that are a bit less good in nature, but can also be drawn from range high straight into that market structure high in case of an accumulation. But those return to zones might not have all the primary and internal highs aligning, and you don't really see, the very clean curling down effect. But a return to zone can also be based on, is there just any supply in general? So maybe the highs aren't the best, but there's also no supply in that region, causing the move up to be fairly simple because there's no supply backing and holding price down or preventing price from coming to that range high. So the highest probability model will have the cleanest return to zone as always, but not every model is going to have the textbook return to zone, which is also where the two exceptions right here that I'm going to be elaborating on come into place. But besides the two exceptions, there are also just return to zones where you have some highs or some lows aligning, but there's just no supply or no demand that can prevent price from coming to your technical target, which can also be considered, within the right context, a good return to zone. A very common exception that I've seen traders struggle with when drawing return to zones is that you have a good return to zone from the starting point of the range, or the opposite point of the range. In this case, within the accumulation is going to be the range high, in the distribution is going to be working vice versa. You have a quality return to zone up until a certain point, where you can see that you have a clean looking return to zone with primary and internal highs aligning, straight until this market structure point right there. But then that final phase where your third tap is coming into the third tap POY and you get your bullish breaker structure, that final phase of the model is in a bit of a more explosive and aggressive environment. There will be situations where the final part of the total return to zone has relatively more aggressive price behavior. This does not invalidate the total return to zone and can be seen as a final manipulation event. When combined within the right total context and timing, you can gain confidence in the expectation of the manipulation. When I'm looking at an accumulation and we are in very high probability context for more upside, any move down that is more aggressive coming into that third tap is automatically going to be viewed more as a manipulation event rather than you having a model but it's kind of counter context, and then that final phase of the model is relatively more aggressive. When you're counter context, you want everything to be even more perfect than if you are pro context. So when you're counter context, an explosive move can kind of invalidate the model. And we're going to be diving deeper into context as well later. But when you're within the right context and you're truly expecting an accumulation to take place, a relatively more aggressive move into the third tap is very optimal for a reversal, because it just indicates liquidations and fear coming into the market within that POY, which is very vulnerable to getting reversed if the purpose of the range is to accumulate and go higher. So when I'm talking about within the right total context, that's what I'm kind of referring to, okay? With the expectation of the final manipulation event. From a timing standpoint, it is mostly going to be timed with the New York Open, okay? Oftentimes, New York Open loves to have a manipulation hour, where the first hour of New York is manipulation. So if New York opens and you see a relatively more aggressive move into the third tap compared to the total return to zone build up prior, then from a timing standpoint, you know that that first hour can deliver that sell into the third tap, followed by the buy as the reversal. So that's what I've been saying. When combined with the right total context and timing, you can gain confidence. Where if that manipulation is taking place usually within the first few hours of a session, that is a +1 in gaining confidence that is going to be a manipulation and you're going to get reversals, because the opening of the sessions are very manipulative, where New York has usually the biggest manipulation. Besides New York, I would say it's Asia for crypto. London usually does not do a whole lot. But I want to clarify that if you get that total return to zone and only the final part is a bit more aggressive, if you're in the right context combined with the right timing, you can gain the confidence needed to enter on that break. Because sometimes you will create some sort of supply that push price down into that third tap POY. And I've experienced a lot of traders that struggle with entering here because you got a relatively smaller supply POY right above that market structure high. But because we are expecting a reversal, the purpose of that supply is not to deliver the lower high for the lower low, but the purpose was rather to mitigate that demand. And from there, they switch to buying programs. Okay? So that's what I mainly mean with when you're combining it with the right total context and timing, you can gain the confidence in the expectation of the manipulation if you have, relatively speaking, more aggressive price behavior. And experience will allow you to get a feeling for this more and more as well. So if in the beginning it's obviously going to be, or if in the beginning it's a bit more skeptical for you or a bit more doubtful, that's completely normal. Okay, we're going to be showing examples, elaborating on it more and more. The final kind of variable of having a quality return to zone is looking at the return to zone on multiple time frames. Okay, where there will also be situations where the return to zone is going to be divided into two parts. The higher time frame return to zone, which we're going to be seeing here in black, and the lower time frame return to zone, which is showcased in red. Where if you're looking at this model on a specific time frame, just a relatively higher time frame, and you see that return to zone, then maybe the final part of the return to zone on that time frame will have a relatively faster move towards the downside coming into that third tap POI. But if you zoom into that final expansion on the of the higher time frame, you will realize that that expansion on the higher time frame on the lower time frame is mainly just liquidity. And you can just see lower time frame, lower highs and lower lows, which you can see here in red, that have no supply of any kind that can, hold price down from getting the reversal back towards the upside. So sometimes you have to go on multiple time frames to realize that you have an overall higher time frame liquidity curve, where that final move down on the lower time frame is also only consisting of liquidity, which then is still a very high quality return to zone. So again, we have just the picture perfect return to zone right here, which does happen, but not all the time, where on that same time frame, you can draw that return to zone from your range point straight into the market structure point. Very easy. There are going to be situations where sometimes it's a relatively more aggressive move of the final part of the return to zone. This does not invalidate the total return to zone, and based on timing and context, we can actually still use that as a proper confirmation and actually sometimes gain confidence in the reversal because this is such obvious manipulation. And then the other situation is going to be the return to zones where on the higher time frame, it looks like that final phase has a bit of like a more relatively aggressive move down, but on the lower time frame, it's mainly just still liquidity, and we can just use that lower time frame break as our entry, applying the domino effect as elaborated in lecture 1. Okay? And besides that, from a return to zone perspective, with the primary and the internal highs and lows, you guys know the deal. The second variable is going to be range duration. And range duration is going to be something that I've actually added more recently to my trading, mainly because I struggled elaborating to members why I did not take a certain model that did meet the return to zone requirements and the overall other requirements that we're going to be diving into. But I always just stated, yeah, the model is irrelevant. But I never really knew how I could objectify that statement, because irrelevant is a very subjective statement. And I came to the realization that the models that I take are simply higher time frame models. But it's not a higher time frame model from a time frame perspective, because we validate ranges using the 6 candle rule as well. So sometimes you're going to have a 15-minute range that's not valid on the 30, so therefore it is the 15, which can be seen as a relatively smaller time frame, but the model is super big. It's just you don't have the 6 candle rule. So I'm looking at it more from a range duration perspective, where the definition of range duration is the time spent between the starting point of the range until the break of structure confirmation of your model. So when we have our model 1 distribution as showcased here, the range starting point right here, up until that break of structure confirmation right there, the time that it took in between those 2 points is going to be our range duration. And we want to be focusing on the models that have a minimum of 1 day in duration. Where usually, if they have 1 day in duration, is going to be around the 1 day and 10 hours, which is something I've noticed purely from experience. But this is going to help you avoid taking these low time frame models that do look good, but they're not relevant enough. Unless you are very advanced in context building and you know exactly where you want to see which model, then you can trade the lower time frames. And we are going to be diving into some exceptions of this rule later on in the next section. But overall, your average, consistent, high probability TCT model will have a minimum range duration of 1 day. So focus on the models that have a minimum of 1 day in duration to avoid trading irrelevant models. Very simple, B2, range duration, minimum 1 day, measured from the starting point of the range until the break of structure confirmation of the third tap. Section B.3 is going to be selecting the quality third tap POI for your Model 2 schematics, which, based on my experience, is by far the most difficult part of the TCT models for most members so far. Where people tend to sometimes misuse a POI and validate that POI as a third tap when it's simply not a third tap, which is obviously the worst that we can do, because then you think you're trading a valid model when you're not trading a valid model, and all your order flow objectives based on the confirmation is not true, and you're trading a system that is not backed by data because you're not validating the proper third tap. So selecting the quality third tap POI is going to be very important to understand. Otherwise, you're going to have so many situations where you will get wicked out and you feel like the market is against you purely because you're not understanding where the market makers are supposed to be pushing price before reversing. And it is fairly simple to follow from a rule-based perspective. And I have to give Mr. Luby Lou also credits for this idea, because it's going to be based around the tab 1 of our TCT model, which is something he has been telling me and helping me with as well. So to get a quality third tap POI, we want, first of all, a high probability third tap POI that is located around tab 1 of our model. And this is obviously going to be focused from a Model 2 TCT perspective, because a Model 1 simply takes the second candle's high or low and you're done. It's from a Model 2 perspective where we need to understand what the exact POI is, where we want price to come towards before the reversal. And it all starts with, first of all, a high probability supply or demand area, or obviously an extreme liquidity area. But from a high probability supply and demand perspective, it all starts with first getting a high probability supply or demand POI based on order blocks that are also validated on the lower time frame as structure supply, where the true inefficiencies are located, just like I've been explaining in the overall supply and demand lecture previously. So first, looking at the POI itself, it needs to be a high probability POI, a good order block at a good location in that pivot point, sweeping liquidity, where there's a low time frame inefficiency and not just liquidity on the lower time frame, an actual valid third tap POI. Okay, from a location standpoint, the highest probability third taps are going to be located around tab 1 of your TCT model. In the previous mentorship, I always told you guys that after that second tap deviation, we extend our range high or low to the second tap deviation high or low, to then identify our third tap POI for a Model 2 and be prepared for a Model 1 once we take the high of the second tap again, or the low of the second tap in case of an accumulation. And in this case, for this example, we're focused on distributions. However, these days, you will see me keep the range high or the range low at my original range starting point. And your highest probability models will have third taps that are around tab 1, preferably a deviation of tab 1. And it also makes sense if you try to rationalize this concept, because when we're trading TCT schematics, we are simply trading range deviations with a purpose behind it, which is Wyckoff, or at least which Wyckoff has elaborated on. But in the core, we're trading range deviations. You can see your initial range high and your initial range low as your true core range, as the original range starting points. And everything above that original range starting point is a deviation, and price wants to come back inside. And when we're trading range rotations, where we're trying to short at range highs and then reverse it down to range lows, or we're trying to long at range lows and reverse it up to range highs, then obviously anything above that original range high is going to be an extreme, because we're deviating the norm. Because what we establish as our range high and low, anything in between that region is our norm. So getting the best shorts is obviously going to be at a deviation of that norm, because then we have the best RR entry opportunities if we're reversing back down. You're going to get a better RR short opportunity if you find your short above the norm right here in the extreme, deviating that tab 1, than if you find a short somewhere in the middle of this range in premium pricing to then take it down. You want to get the extreme entries. And I came to the realization that our highest probability models, the highest probability third taps that look good, are usually always deviating tab 1, or at least at tab 1. They can be slight underneath it sometimes if there's really no POY higher up that can also get tapped into. But the third tap POY is usually a deviation or at/around tab 1. So when we can find these high probability supply POYs that are at tab 1, and when price comes into it, we are around tab 1 or deviating tab 1, these are going to be the highest probability third tap POYs with the least amount of room of error. And you're going to be trading the actual extreme points for the truest reversal, delivering the highest RR opportunities. So, having an example here where we're trading a model 2 distribution, right? When we're identifying our third tap POY and we're in a situation where we have a distribution that looks like this, and in this pivot point right here of our second tap, we have a 45-minute block. And within the 45-minute block, we also have a refined 30-minute order block. And within that 30-minute order block, we also have a refined 15-minute order block. When we're selecting the third tap POY that we want to use, if there are 2 or 3 structure demand or simply supply and demand POIs for a third tap, we prioritize the area where price would be the closest to tab 1 or a deviation of tab 1. So in this example, we have a 45-minute order block, where within that 45-minute block, we have the 30-minute block, and within the 30-minute block, we have a 15-minute block. We preferably want to prioritize the area where price will be the closest to tab 1 or a deviation of tab 1, which in this case, as a minimum, would be that 30-minute block. Because at the 45-minute block, we're close to tab 1, but we're not deviating tab 1, or we're not exactly at tab 1. So price could surge up higher to tap into that 30-minute block before reversing back down. So when you're entering right here on the 45, there's going to be some slight room of error. Now, if price comes towards the 30-minute order block and it has a refined POI of the 15-minute block, the 15-minute block does not need to get mitigated, since in order to mitigate the 30, we are already deviating tab 1 right there. So see the deviation of tab 1 as your extreme. If your third tab already deviates tab 1 and mitigates supply in here, you should not care about there still being a refined block higher. So when you're selecting your third tab POI, don't select the 15-minute block if that's the most extreme, because you also have a 30-minute block where if that gets mitigated, price is already deviating tab 1, which is your extreme requirement. You can put the 45-minute block on the chart because that is going to be around tab 1, but you have to also see how price behaves coming into the block to see whether you're going to be using the 45 or the 30, or maybe you're trading both and you have to take a loss before getting the W. But I want to clarify that deviating tab 1, that's the maximum requirement that you can set. So if you're already mitigating a block while deviating tab 1, it doesn't matter if there are more refined areas above it. If you get your confirmation, you can take the trade and you can keep the stop loss above the local high and not above this high because there's room of error. No, if you're already deviating tab 1, you do not care about any refined areas even above the area that you're tapping already into. When you're trading the 45 and you do have a 30-minute block higher, you need to be cautious. I'm not telling you to not take it because it's context dependent. And what I'm telling with context dependent, or what I'm trying to elaborate on when I'm saying context dependent, is if we get a super high quality return to zone, straight into that market structure low, wherever that low is located, right? A beautiful return to zone. Maybe we even have a range inefficiency, which is also elaborated within the high probability variables of the TCT Mentorship 2024. Let's say we have that beautiful return to zone. We have a range inefficiency. You are already deviating the volume area high. You're breaking back inside, and it's a very aggressive, fast breaker structure. And while you're breaking the market structure low, you're already also breaking outside of that return to zone. Like, what's going to be there if something like that happens? What's going to be there to support price to deliver that move up to the 30? Not that much. If you have all the variables I just mentioned, meaning you just have a clean return to zone with that return to zone coming straight into that market structure low, and if you break that low right there, there's nothing but just liquidity below you, and you have a beautiful return to zone, range and efficiency, it's a very aggressive breaker structure, what's going to be there to hold price up to deliver something like this? You know, probably not a whole lot. And you can already expect the reversal down. But let's say you have something like this, and right below that market structure low that you're trying to enter on, you got some demand right below it right there. You know, let's say you have some demand right below it, or there's a bit of a more of a gap in the overall return to zone where you do have a clean return to zone in this region, but that final region is kind of lacking in return to zone, and there is some demand in here that price can tap into. You know, if it's not that obvious, then you want to be more picky with your entry. And therefore, if price taps into there, maybe you can get that move down to this region before eventually having another leg up right there to mitigate that refined 30 block to then truly get that reversal back down. So when I'm talking about context dependent, I'm like, how high quality, based on all the variables that we're going to be discussing, is your model when you're tapping into the POI? And then you're obviously simply waiting for your confirmation. If you don't know if you need to use the 45 or the 30 in this example, but there's no confirmation coming into the 45 and you go straight to the 30, well, then there's your problem solved, right? That is extremely simple because the market doesn't even give you an opportunity to enter on something else. But it's important to understand that deviating your tab 1 is the extreme. You don't need to come for refine levels if your third tab is already deviating tab 1. If you're below tab 1 and you do have refine levels that allow you to deviate tab 1, you need to be cautious of entering on that third tab and only take it if it's very high probability, or simply accept the fact that you need to take an L before getting the W, which sometimes simply happens, right? There are many times where I have to take an L before getting the W. But I'm not saying it happens all the time. There are just going to be situations where that's inevitable, which is completely fine because the RR of the winner is always going to outweigh the RR of the loser. Okay? Now, obviously, the same rules apply in case of extreme liquidity POIs. So we're going to be shifting it to an accumulation from an liquidity perspective, where if there are two different higher lows in a cumulative environment, you pick the higher low that is at or around tab 1, where the third tab is at or around tab 1. So in this case right here, we can kind of see that we have in the black, which is representing a lower time frame, we have a 30-minute higher low located right here. And then in red, which is the 1 hour time frame, our higher low following the 6 candle rule is going to be up here, above the 30-minute higher low. Our tab 1 of the accumulation is going to be located right here. We want to be trading or using the extreme point that is the closest around tab 1, preferably a deviation of tab 1. You don't always get the deviation, which is completely fine, but then you're picking the POI that is the closest to being around tab 1. So in this case, I will never use the 1 hour higher low because that is way deeper in the range right here versus the 30-minute higher low that is right there, which is closer to tab 1. It could also be that the deviation towards that 30-minute higher low is pretty steep and you grab that liquidity doing something like this. That's completely possible. And then obviously that solidifies this as your proper POI, because while sweeping your third tab POI, from an extreme liquidity perspective, you were already deviating tab 1, which will happen quite often, which brings, a lot of confidence in the fact that putting your stop loss there once you're entering on a lower time frame break in here, you just have a lot of confidence in the stop loss placement because it truly invalidates the model. Like, if it takes out that low, you're simply wrong, and there's no room of error, which will also happen here and there. But when you're initially pre-planning the extreme liquidity POI, you're going to be picking and focusing and putting the importance on the 30-minute because closer to tab 1, and you'll be trading more of an extreme. This is trading way too deep in the range itself. And then we obviously have the exceptions of the extreme liquidity POI within TCT models, which is something we have already elaborated on within the liquidity lecture, which is, again, super important to understand because on the left here, we have our Model 2 accumulation schematic, okay? However, we're not going to be using that first higher low if that first higher low grabbed the extremes of that first initial expansion away from the second tab. Exactly like we talked about in the liquidity lecture. If that first higher low grabs the liquidity of the initial expansion from your second tab that is already part of the accumulative price behavior, and that low, because it grabbed liquidity, isn't your liquidity low. And oftentimes what you will also have is that you have some sort of a demand creation because of the V-shaped reversal because you actually swept liquidity. But it doesn't always need to be a demand POI. If there is a demand POI, that's going to be extremely easy to use as your third tab POI. But there isn't always demand. And if there's no demand, I want you to understand that your primary focus is going to be on that second higher low, right? Where this higher low did not grab the extremes of the previous expansion. And just the purpose of it was a higher low that price then can later on come back for the reversal back up. So you can see that this higher low, if you were to deviate it, would be around tab 1. And you would deviate tab 1 in order to deviate that low. And so in a normal trading environment, that would have your priority. But we're not in a normal trading environment. This grabbed the liquidity of that first initial expansion, got the move away, most likely with an inefficiency creation or a demand creation. But even if it didn't, the second higher low, if that purpose was just to put in a higher low and it didn't grab the extremes, then that's going to be your liquidity target, despite it being deeper in the range. So very important to understand that exception. And the same goes when we're trading a TCT model where the second tap of our TCT model had its own individual TCT schematic. So there are going to be situations, and this happens quite often, where you're going to have your initial range high and you're going to have your initial range low, and coming towards that second tap on the higher time frame, where this is going to be your top 1 and that's going to be your top 2, there are going to be situations where your top 2 has its own lower time frame distribution schematic right here. In this case, a model 2 distribution. Happens quite often. If your second tap has its own distribution schematic, then this tap right here is obviously not a liquidity target from an extreme liquidity perspective on the higher time frame, because this was part of your lower time frame 1, 2, and 3. And if this is a valid 3 on a lower time frame, that means it grabbed either the extreme liquidity or the extreme supply of that expansion towards the downside after putting in that lower time frame second tap. So this third tap, because again it grabbed the extremes, in this case therefore also being part of this lower time frame TCT model, is not going to be your target from an extreme liquidity perspective when we're trying to trade a high time frame 1, 2, and 3. So when identifying our third tap POY from a liquidity perspective, then this first lower high for the lower low on a higher time frame is not going to be our third tap POY from that liquidity perspective, despite it being around tab 1, where price would have to deviate tab 1 in order to grab that point. Now you're using the second lower high for the lower low as your liquidity target. That is not particularly direct part of this distribution. If this is an extended distribution where you have a 1, 2, 3 and price comes back for the extreme supply once more, let's say right here, it comes back for the extreme supply created in there, then that's also not your liquidity target, because then that's simply an extended distribution model right here. That's simply an extended distribution model before completing the move. And then that would also not be your third tap POY from a liquidity perspective, because you go to 1, 2, 3, and then the lower high for the lower low, again grabbing the extreme supply before going lower. In that case, is going to be this one right there. So you have to identify, if you have a TCT model, an individual lower time frame TCT model within the second tab of the higher time frame model, check which highs were part of the distribution schematic, and those highs are not vulnerable to being extreme liquidity highs when we're trading the higher time frame third tab, because you already had the distributive price behavior in that region. Okay, very important to understand, because I've seen people miss out because they had the wrong extreme liquidity, not realizing that the extreme liquidity they pinpointed was already part of the overall distributive price behavior within the model. And lastly, we have our quality breaker structure. And it's very important to understand the quality break, because otherwise you'll literally get stopped out before the actual move happens. Because I've seen a lot of people enter on fake breaks because they did not understand the definition of a quality breaker structure, which is fairly easy to understand because it's very rational, okay? A quality bullish breaker structure, in this case, because we're using a bullish breaker structure as an example, again, it works vice versa when we have a bearish breaker structure, but a quality bullish breaker structure has a V-shaped move towards the market structure high, creating proper price displacement above the market structure point. The move is clear and aggressive. It's a clear and aggressive expansion away from the third tap mitigation and is supporting price up, oftentimes via the creation of demand. So what we can see here on the left is that price taps into our third tap POY from a Model 2 perspective, for example, and we see a V-shaped move, a clean sell to buy move that is closing above that market structure high with some decent displacement above, meaning you don't have a tiny candle close above. It's a nice steep candle towards the upside with a thick body. Not a lot of wicks, just a thick body closing and coming towards that market structure high and closing above it. Where when we're talking about an aggressive move and a V-shaped move towards that high, oftentimes in the process of coming towards that market structure high, you will see some sort of an inefficiency and therefore also a demand creation, where there's going to be an actual order block in the lower section, or a structure demand POI, or sometimes you close above it and you validate this total region as structure demand when you're breaking it. That is all good, okay? But you're basically entering on a break that is supporting price to go higher and is protecting price from coming to your invalidation, which is right here. A poor bullish breaker structure is a slow move towards that market structure high with little price displacement above the market structure point. The move is creating sell side liquidity, giving price reasons to come back down again. A good breaker structure will protect your invalidation. A bad breaker structure will target your invalidation. So let's say this is again that third tap POI from a Model 2 perspective. If you're watching for this market structure high to get broken, but instead of seeing that clear V-shaped move, your V-shaped move is now turning into a very broad V because it takes so long to get towards that point. Because you're coming up slow, you're automatically, most likely, creating a lot of sell-side liquidity below. When this is the case, you're very vulnerable for price to deviate above that market structure high, close above it, but not significant. And because that liquidity is there, that can act as a magnet for price to get another sell-off before actually getting that proper breaker structure, if your overall idea to long there based on the high probability Model 2 accumulation was correct. But right here, when you're coming up slowly, you're giving price reasons to come back down while breaking it. So if you come up slow, leaving a lot of lows intact right there, building sell-side liquidity, you need to be cautious with entering on that break. Sometimes the move up is relatively slow, but the break is super aggressive, and you do create some sort of structure demand in the process, where the initial move was slower, but the break itself was very aggressive. And then you can look to long on that retest right here, where you're anticipating a tap and go, as we have explained in the supply and demand lecture, where you're expecting a tap and go, because if you start to close candles within the block, you can expect price to take all that liquidity. But if the price displacement and the closure above that market structure high is also little to none, then you're very vulnerable for a deviation. And you need to be careful with entering on that break. And there might be, a tiny little order block right below here that price may want to come back for before getting the actual reversal. And if you don't understand this, you're going to be in such a mental tough situation because you just got stopped out on your trade, and then you would have to be re-entering immediately while being in that kind of like bad state of mind, right? Which is where a lot of people have missed out on proper trades because they entered on the wrong first initial break. And obviously, if you also simultaneously have like supply levels above that market structure high and you're coming into it slowly, you definitely don't want to be entering on those breaks. You need to wait for some proper, V-shaped price action, as in here, which could develop afterwards within the same idea overall. But it's very simple to understand, because when I'm talking about aggressive moves or slow moves, it's hand in hand with, demand creations or liquidity creations. Where if you have a demand creation, well then that is protecting price from coming to the invalidation. If you create demand on that break, that can support price for the higher low, for the higher high, and your stop loss is below that support, which is amazing. Whereas if your stop loss is right there and you have a liquidity trail up towards that high, then your stop loss is so vulnerable of getting taken out because you are part of the liquidity that market makers can come back for before reversing. Where then here you might create that demand again and you have the proper V-shaped price action. So the simple sentence is a good breaker structure will protect your invalidation, which is your stop loss placement. A bad breaker structure will target. your invalidation. Now, you don't always need a crazy V-shaped move with the perfect inefficiency and the perfect demand creation in case of a bullish breaker structure. Just getting a steady move towards the upside, not building a lot of lows, having a decent closure above is also good when we're combining it with all the other high probability variables. But the more explosive, the more aggressive, the better, obviously, because it's indicating that at that specific point in price, within that specific timing in the model, you have market makers stepping in, bidding price higher or lower, depending on the accumulation and distribution. And that is something that you need to really let resonate. What these TCT models allow you to do is anticipate at a specific point in price and a specific point in time within the model for the market makers to exactly at that point step in and bid price up in case of an accumulation. So you preferably want to see some more aggressive candles with some volume coming in because you're anticipating on market makers right now stepping in, bidding price higher. Because the accumulation is going to complete itself if you have market makers that are willing to step in and bid price up. Otherwise, your model is failing. So getting some sort of a more aggressive break is helping you with the confidence in the anticipation of market maker stepping in and supporting price in your direction. Okay, so our high probability advanced TCT model is going to be consisting of this. This is a nice little screenshot for you. Okay, first we need a high probability ranging environment, which is confirmed via a quality return to zone, which can be a quality curve that has two different variables like we previously discussed, but it can also be trendline liquidity, where trendline liquidity is also very high probability, but you'll more often see actual return to zones than trend lines. But if you have a clean trend line, that's also a very, very high probability ranging environment. The second is going to be a minimum of 1 day from a range duration perspective to avoid trading irrelevant models. We're going to be having two exceptions in the section C, but for now, focus on the consistent, average, high probability advanced TCT model with a minimum of 1 day in range duration, where usually if it's 1 day in duration, it will also be around 1 day and 10 hours from personal experience. Our third tab POI, the best POIs are going to be having a deviation of tab 1, but you want to be selecting the POI based on the high probability factor of the POI itself, with your order blocks that have true inefficiencies on the lower time frame, while being located at or around tab 1, where the best case scenario is always going to be a deviation of tab 1, where the breaker structure needs to be a fast and aggressive break, preferably creating supply, protecting price from coming to your invalidation. So what I've drawn here from a model to distribution perspective is going to be your textbook model. Okay? Screenshot it, study it, understand it, be able to identify it, and then we're going to be diving into some live trading examples. Peace out.